So how do you find the best rate you can on a HELOC? Just understand that rates out there are going to be different when you're shopping around, from banks to credit unions to mortgage brokers. So how do you make sure you get the best rate? It comes down to looking at one factor when you're talking to your banker, your mortgage broker, or whoever. I went through this example with a client last Friday when we were talking about how does he make sure when he's shopping around to make sure he gets the best rate. First thing I showed him is why it's important. He had a loan for $100,000 that he's looking for. And I said, if you go to this credit union, you're going to get a rate of about 8.5%. And that's going to be about $8,500 a year in interest, approximately. But if you go over here to the mortgage broker who's offered you the same product, your rate's going to be about 12.5%, and you're going to pay $12,500 in interest. So in other words, you're going to pay an extra $4,000 for the same product on the same home with the same credit income. So in other words, why would you pay that extra $4,000 to a banker when you can use it in your life? Why not take that money, enjoy it, live with it, and stop overspending? So when you're pricing out a HELOC, you have to understand there's a couple different things. And let's look at our example. We have the two things that make up the rates for any adjustable rate product out there. That means like the HELOCs, but it also means student loans and credit cards. They're based on the same two numbers. Number one is the index. Number two, what they add is something they call margin. So again, you have the index and you have the margin. Those are the two things that make up all rates when you're looking at adjustable mortgages, credit cards, student loans, remember. And with these two numbers, you're really going to focus on one item, and that's your margin, because your index, no matter what bank, credit union, mortgage broker you're going to go with, is going to be the same. So across all lines, they use the prime rate from the Wall Street Journal. So that's not going to change. Yes, the index is going to go up and down, but it's going to go up and down the same across all banks, credit unions, and mortgage brokers. So I gave him this example. So have you ever drove up like Broadway here, which is a busier street, and have you gone by gas stations? You went by the first gas station and it's $3.52 per gallon. And then the next one is $3.42, and then you find a third one that is only at $3.14. So what's the big difference? These gas stations are close, within a mile or two of each other. They all get their gas from the same refinery here in town. So they're all paying the same amount, the same base rate for their gas. So why is one $3.14, one $3.42, one $3.52? It's because of the profit. Each location is looking for a different profit. That is no different than a bank. The index is what they pay, let's say, for the gas. They're all paying the same amount for the index, or that's where they start. The difference is what they call margin and we call profit margin. Because what you're going to find as you shop around is this margin is different, and sometimes drastically different depending on where you go. One of the credit unions we love here locally has a 0% margin, so they're not adding any more profit to their base rate. Where we see other institutions at 2, 3, sometimes even 6% margin on top of the index, so their rates are going to be higher. So I go to Steve, if you're looking and you're shopping around, the very first thing we're going to look for is the margin, knowing that the index is going to stay the same. Because we know the margin plus your index is going to equal your full rate that you're going to be paying from that institution. So if we're looking at the only thing that's changing is the margin, let's shop only for the margin until we could find the 3 or 4 lenders that have the best margin. After that, we'll take it to the next step is look at cost and some terms. But let's start with what we're going to be paying over time, because that's your biggest cost if you're going to keep this HELOC 5 or 10 years. You want to make sure you're paying the lowest rate. So let's look at the difference here. Just like I said, if someone has a 0% margin and the index in this day and age, the prime is 8.5%. So that means your rate's going to be 8.5%. Compare that to someone else who may have a 0.5 margin, then your rate goes up to 9. And this continues to climb as the banks, the credit unions you're looking at, their margins increase. But why do people pay 4% on a margin when they could pay 0%? Typically, it's lack of understanding how rates come out, because they never talk about margins up front. They talk about it later on. And also, sometimes they just go with what's convenient. And what's convenient is what handicaps people over time. Well, let's look at this loan. Like in this case, Steve was looking at $100,000, but if he had an 8% rate compared to a 10.5 or 12.5, he's going to pay somewhere between $5,000 and $4,000 extra in interest. That's extra money that he does not have to pay, that someone else is not paying. And over time, what I show him is if you keep making this error in judgment on HELOCs, on student loans, on credit cards, whatever it may be, it adds up over time. And even after 5 years, you're paying out more money to the banks than you need to. That money should be pumped into your life to enjoy it, to relax a little bit, relieve some stress, just pay some other bills, accelerate your debt, or just go enjoy life. But we want to make sure you're paying a fair price for the loans that you're taking out. So you have to understand a few of these things like margin, because as you see, like people who make these errors over their lifetime, over 30 years, they're paying tens and even hundreds of thousands of dollars extra for their debt. Like I told Steve, when you're out there shopping for the best interest rate for a HELOC, start with margin. Go through and call 10 or 15 credit unions and banks and find out who has the lowest margins. Once you get to the 2 or 3 that have the best margins, then we're going to start shopping for any other cost or terms to make sure he's getting the best rate. If you want a cheat sheet to help you shop, there's a download below. If you have any questions, comments, or would like to see anything else, just leave it in the comments below. Share, like, and subscribe. We want to help as many people out there as possible spend less money on debt and pump more money into their life where it belongs.